Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, March 24th, 2017. Very quick video on the broad markets, and really what I wanted to kick this off with is just a strategy. I've mentioned this on and off over the years, but as new people come into the site, and others may not have remembered this trading strategy. Let me share I think, one of the best trading tips that I can share, whether you are a active trader or an investor, part-time trader. I know a lot of you work full-time jobs, and trading is either a part-time hobby, passion, whatever you want to call it. And even for those of you that trade full-time, I find this use of OCO orders, or one cancels the other, very useful. Just about every broker, I don't believe there's a broker out there that won't offer these. They're usually under conditional order types. And every broker has a different entry system, but let me explain real quick. And let me jump to a different board here where I set something up. So here's an example of how you would use an OCO order. The benefits that I've talked about are, number one, first and foremost, it's discipline. From what I can gather over the years, even my own Achilles heel is sometimes being lax on your stops. Trading's all about risk reward. If you're taking 3-to-1 RR, meaning you're risking a dollar of downside for every $3 of profit, but then you let your profits run on your losers run, and you're taking $3 losses on trades that you're shooting for a $3 target. Well, you have to be right a lot more often than you have to be wrong. The thing about using an attractive R to R is you don't have to be right every time. In fact, you don't have to be right all the time. However, the golden rule in investing is let your winners ride and cut your losses. And a lot of people, they understand that in theory, but yet in reality, it's a different story. And I think most of you, if you've traded for a while, you know what I'm talking about. So the OCO orders, they're also known as OCA, one cancels another. Again, different brokers will use a different terminology. They're very simple, set it and forget it. So what you do, I'm using an example here. This isn't an actual official trade idea on the site. The other day when we were forming these bearish engulfing candlesticks on all the major indices and quite a few different sectors, I had mentioned even before those candles were finalized that they make for very objective short entries, especially when you have a bearish engulfing candle come near the end of a prolonged uptrend, as we did here. I'm just looking at the SPY in this example. So sometime during the day, I mentioned on the trading room, I believe, that you could establish a short with a stop loss placed just above the top of that bearish engulfing candle. Because the way bearish engulfing candles work is they are in themselves, I don't consider them the highest probability sell signals, but when there's follow through to the downside, and that's what we had the next day, we traded down and we took out those lows and we closed right about on them. Some indices we even closed below those. So so far they're confirmed. Would it have been better to see some follow-up impulsive selling? Absolutely, but however they're still intact, and the bounce so far has been relatively muted, and we're not anywhere close to coming over the top of those bearish engulfing candlesticks, which would undo their bearish nature. So an OCO order, simply, let's say during that day, you had shorted, you put a short on somewhere here, the bearish, we had engulfed the previous day's candle at this point. And again, it also shows better on some other indices. I could have used a different one that shows that we engulfed even more than just the previous day or two's of trading. But here it is. So you shorted here, let's say it, just use that number, 235.35. And your target, I can see a pretty well-defined support area, potential target down here at 228. So immediately after entering the trade, you turn around at your broker and you enter a OCO or OCA order. One cancels another. And you'll put two orders in. You'll put one order at your profit price, which in this case, let's say your price target. And again, hypothetically speaking, I didn't adjust this for an optimal fill. Just looking where the support is, let's say you're targeting 228. And your stop loss you want in case you're wrong, and we go ahead and take out that bearish engulfing candle, which would be pretty bullish to see the market move above there. So you have a stop loss placed slightly above at 237.80. And the way it works is if you tie that in, bundle those as an OCO order, that means the first of whichever two are hit will cancel the other one. So if your trade plays out successfully and the market or the SPY drops to 228, your buy to cover limit order, that's to close a short position, is filled at 228 and you made a nice profit. However, if wrong and the market goes up and exceeds 237.80, then you will be stopped out for a relatively small loss. And again, the benefits other than discipline are those of you that work full-time jobs, can't be in front of the computer all day. This is the perfect solution, because when you enter these, and do not forget, enter that as good to cancel. When you enter any stock order, most systems the default is a day order unless you've configured it differently, meaning that order will expire at the end of the day. So you want to do a OCO or OCA order with a stop loss above and a buy to cover limit order below, and you want to code or designate those to be good to canceled. Just a little couple side notes. If you're relatively new to trading, I prefer stop loss over stop limit. A stop limit order would sell if and only if at 237.80, but if the SPY gapped above, let's say it opened up the day at 237.85 and then ripped off, that order would be bypassed. So I like the stop loss orders, because if it hits or crosses above that price, no matter where it goes, you'll be stopped out and you don't have to worry about coming home that day. Let's say the day before the SPY closed at 237.70, a little below, and then we have a big gap up. You're at work, you hear the market's ripping up, Dow's up 300 points, and your position's getting smoked. You don't have to worry about it with a stop loss, because it will have taken you out at the open, and that can be a downside as well. But I don't want to digress. There's no one perfect loss mitigation process in the markets. If you use a stop loss order, that is, and it's not a stop limit, that is the possibility, is that at the open on a gap, you're stopped out at the opening price. Sometimes that gap will be faded, but again, it's the lesser of two evils, because a stop limit order can be bypassed. And this works exactly in reverse. If you're trading long, you'd have, if you bought long here, you have your stop loss order below. Again, I prefer a stop loss versus a stop limit. And then your sell limit order would be your profit target above. Okay, so hopefully that helps. And again, I'm a big proponent of those OCO orders, and have quite a few in place myself right now, even though I normally have the luxury of being in front of the computer all day. All right, and as promised, just a quick overview of the markets. I had drawn some bear flags this morning before I had an appointment I had to run out to. Started right when the markets did, so I came back in a little later. So the chart that I posted on the Qs, I showed you the bear flag that I was highlighting the previous day. I showed it on a 30-minute chart, and that chart was reflective as of yesterday's close. The symmetry, at least the way I had drawn that, here I'll show it to you real quick. Let's go there. That one's been taken out. Again, that was a 30-minute chart. Let's see. So here's what happened. We broke down yesterday below it and snap back up and hit the top. Essentially, you have to redraw this, and it's still intact, especially if you clip out that, sometimes when drawing trend lines, it's more of an art, not a science. You have a quick move down and a snap back below, so you could most certainly just revise this trend line any way you want. But more importantly, when you zoom out here, this is a daily time frame now. Take a look, and what you see is a very clear, you still have these flags in place. If you zoom in, let's just highlight this area here, the last few days. This is your bear flag pattern right here. I don't have it drawn out with a trend line, but you can see. So you do have a bear flag in place. There's your flagpole, the impulsive move leading down to it. You might even go off the highs if you wanted in the Qs. And if it breaks down, that should take us lower. So that's still in play. And it even looks more clean when you look at some of the other major indices. Here's the SPY right here. Let me give you a clean board on the SPY. I'll draw it out for you real quickly. There's your bear flag. Still very much intact. A bear flag is simply a continuation pattern by nature, meaning you move down impulsively. That's called the flagpole, the move leading down into the flag. And then the projected measurement, if you take the length of that flagpole and you add it to the highest point of the flag before it broke down, that will give you your measured target. And that comes in roughly, you can see there's a reaction here, there's some support right there, and then I just showed you that other level a minute ago on the example for the OCO order. So I just wanted to point out that these are still very much in play, and you know, they haven't broken down. That would be your sell signal, to see not just the SPY, but to see all the markets go ahead and break down. Ideally, on a bear flag pattern, you want to see impulsive move and high volume leading down, and the formation of the flagpole or the move leading down to it, followed by a little bit lower volume. So far today, the volume's low. Last couple of days, it was still pretty high. That puts it a little bit into question, at least on the SPY. However, most importantly, if we do break down, you want to see volume expansion, and you want to see an impulsive move out of there. You don't want to see prices limp around, bounce around for a few days. That's the nature of a bear flag continuation pattern. Just like a bull flag is the same thing in reverse to the upside in a bullish trend. So there it is, the SPY. We'll look at a few more. One of my favorites, IWM. You can see it's still intact there as well. You see a very impulsive move down. There's your flagpole. There's your bear flag. And if it breaks down, I'd expect something along the lines of this. There's a nice gap to be backfilled right around there, close to that. And I didn't take the actual measurement. I was just kind of eyeballing the lines there. But as you can see, that's what I wanted to point out. And then for you guys that trade the mid caps, I know some of you prefer MDY, same story. You can see the flagpole, flagging action. And as I said in the trading room today, now these have to break down soon. What happens is, if we continue to push much higher, you destroy the symmetry. It's hard to explain. You have to look at enough of these bull flags and bear flags. But when you typically look the pattern up, you know, you're not going to see a flag that is equal to the length of the flagpole or the move down. So therefore, if we continue to rise, let's say into next week for a few more days into Wednesday at this rate, this would grow too large, in my opinion, to be a valid bear flag pattern. But as of now, it's certainly within those parameters, although it's getting stretched. So the ideal scenario, I think, guys, is to see sometime by the end of the day, preferably a dump into the close, and then an impulsive follow through downside next week. Now, I will say this isn't the be all end all. If these potential bear flag patterns do not pan out, that does not completely wipe out the bearish scenario. Most importantly, where we are technically. You know, as long as we're below those levels. I put up the Fibonacci retracement levels this morning on all the major indices. There's some horizontal support levels that, if I had time, well, we can do that real quick. Let's take a look at that chart that I had those fibs on. Let's see, I had SPY. And I believe I had drawn the fibs out somewhere on one of these boards here. Sorry guys, I have numerous boards. I'm clicking off to the right. There you go. So there's all the different fib levels on here. And let's just go to a clean board for a second and just look at price support. Let's go out to we'll go out to 30 minutes. Here's a SPY. I could put some lines here. We have a gap with a reaction right there. There's a reaction high right there. It's also at the bottom of that gap. So, you know, these are the price levels that I was talking about. I didn't put those up on those charts with the fibs. It would have just been too busy, too many lines. It makes it hard to make heads or tails. You know, and as I go through here, we see some reactions here, reaction there. Big gap right there in a reaction. So that's roughly we'll call it a resistance zone. So this is a thin zone. We've already turned down at that fib that I pointed out earlier on the SPY, and you go down the line. So these are the things that I'm looking at that will start to dampen the bearish case. Are again those retracement levels. If I can put those back up. Oh no, I jumped back out to a 30-minute time frame. We need to go back to a 5-minute time frame, find the right board, which was one of these. There it is. There's the Qs. The Qs has retraced the most. Remember, the Qs top heavy. Everybody's beloved Apple, Alphabet, Facebook, those are on the Qs. And so you can see a retracement still falling well shy of the 60% retracement we're rolling over. And then when I look at the Nasdaq Composite, remember the QQQ is just the top 100 largest components. That failed right around the 50% Fibonacci retracement, and I'm talking of the move down. Remember, the Qs were the last to buckle. They didn't top until the 21st, and then they started moving down impulsively, where every other diversified index in the U.S., every other stock index topped on March 1st and has been in a clear, unmistakable downtrend since. We'll just look at the SPY, for example. Go back 15-minute chart, and as I mentioned earlier, a downtrend is simply defined as stocks making a series of lower highs, as we have here, as I'm drawing out, and lower lows. Reaction low there. So, you know, to what would call this downtrend into jeopardy? Well, first, if we took out this previous reaction high, that's a minor one, then we have one right above it. Most certainly this reaction high, and then you're getting up there to, you're getting back close to the previous highs. So as of now, just looking at the charts, trying to do so as unbiased as I can, even on this near-term time frame, I don't see anything more than just a run-of-the-mill counter trend bounce. It happened to coincide with support. I've talked about there are quite a few support levels. Not shown here on the SPY, but I do have a lot of, if I go into the, let's say the Nasdaq 100, here's the QQQ. I have many different boards, but you can see here, 60-minute chart. Let's show you that. Okay, you can see this support shelf. We've had this trading range here for a while now in the Nasdaq 100. It's sort of been topping in this trading range here. A lot of reactions back here at the lows. We had this reaction. That's the level that needs to go. 129.75 is sort of the magic number that I'm looking at right now on the Qs. If it goes, it's going to come on a follow, on a breakdown of this bear flag pattern as well, and it will almost certainly take us down. I have the bear flag measured target down here, but I have a support zone below, which I think would be the target. Although there is a little support there, I could draw that out. You can see a little blip, some reactions right here, and that comes right in with that bear flag measured target. Although, again, I'm leaning towards this one overshooting that a little bit, hitting that support 1 zone. Yeah, I think I'll wrap it up here. There's not much else that hasn't been said. You know, the bigger picture with the divergences, the extreme overbought readings, extreme sentiment readings, everything else, the divergent high. A lot of trend line breaks, as I mentioned. The SPY is broken down. And now bear flagging, IWM has clearly broken down. We had the confirmed negative divergences you can see here. And you can see IWM, that led the way down. That one has dropped the most so far. And look at that support shelf. I mean, it's a beautiful support shelf. As I often say, the initial reaction or the initial tag of a support level when it hasn't been visited in a while. I mean, obviously the initial tag is the first one. I'm talking once we've bounced and haven't visited that level and you come down, almost always you get a reaction. And I define a reaction as a bounce and or a consolidation. So far, this has been a very muted bounce, more so of a consolidation. That 135.45 is that S1 level. If and when that goes, we have a little support here. However, that's a very long, that trading range goes all the way back to early December, and I think it'll be a powerful sell signal. I don't see any reason on this chart, and this is a daily chart, much more important than the 15 or 60-minute time frames. You put a higher weighting on the daily charts. If this support level breaks, that 130.35 level support, I think, would be at best a speed bump on the path down to 125.66, my minimum correction target, and that would be a drop of roughly 6%, so another 6% downside in the IWM. And if we get that bear flag breakdown, especially with all the other indices, then I think that's good chance that's going to happen. Trend indicators are bearish. You have a crossover on the PPO signal line down below the 0 line. You have negative divergence confirmed at that divergent high, bearish rising wedge breakdown. So again, this just looks like that looked like the first counter trend bounce and following this wedge breakdown, followed by the next leg down, a little reaction here at support. Maybe we get one at 130.35, but that's what I'm looking at. And I've been mentioning for weeks now that IWM's my favorite. with QQQ being my second favorite, and I have no desire to short the SPY. Most of my positions are longs and shorts, individual stocks and ETFs. That's usually what I prefer to trade. All right, we'll wrap it up here. Keep it under 20 minutes. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.